Zscaler reported quarterly financial results that beat management forecasts, and yet the stock price fell by roughly 20% following the earnings release anyway. The price decrease was primarily a result of the weaker than expected forecast for the company's 2025 fiscal year. I will review the company's latest financial results, including its revenue, profit, and cash flow. I'll also evaluate its 2025 fiscal year guidance and identify the reason investors were disappointed in this outlook. Finally, I'll update my buy recommendation for Zscaler stock and let you know if I think it's a buy, hold, or a sell following this dip. So let's take a look. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Zscaler CEO saying that we ended a successful fiscal year 2024 with fourth quarter results exceeding the high end of our guidance across all metrics. And that's what I talked about earlier. The company beat their own expectations, the higher end of their own expectations, and yet the stock price fell. You can see the price action here following the earnings release. You can see that big drawdown. The stock was trading closer to $200 per share, and it took a roughly 20% dive following the earnings release down to $158 per share. Company reported $593 million in revenue, which was an increase of 30% year over year. Its GAAP loss from operations improved to $27 million compared to $44 million in the same quarter the prior year. Remember, as I often say, I don't mind investing in companies that have negative profits as long as they're making improvements towards profitability. Zscaler certainly demonstrating improvement, improving the loss on the bottom line by $17 million year over year in Q4. Cash flow from operations is solid for the company. It generated $203 million in cash flow from operations, which is 34% of revenue. That's a very solid percentage compared to just $136 million in the same quarter last year. Their cash flow from operations is robust and it's improving. The main difference here from operating income and cash flow for Zscaler is stock-based compensation, which the company employs extensively. That could dilute shareholders in the future, but when it's generating such strong cash flow from operations, the company can use some of that cash flow to opportunistically buy back shares, which it might do following this big decrease in the stock price. Deferred revenue as of July 31st, 2024 increased by 32% to $1.9 billion. This will eventually turn into revenue when the company performs the contracted upon services. Now let's look at the guidance that disappointed investors so extensively. The company is forecasting revenue of $2.6 billion, billings of $3.1 billion, and non-GAAP income from operations of $535 million at the midpoint. Let's compare each of these to 2024 and determine what was disappointing about the guidance. So let's start with revenue at $2.6 billion. If we look at 2024, the company generated $2.167 billion in revenue, which was a 34% increase year over year. Now, when you look at the guidance of $2.6 billion in revenue, that's a roughly $450 million increase, or a lot slower than the 30% revenue growth the company generated in fiscal year 2024. So the deceleration in revenue growth is one primary reason that investors were disappointed in the 2025 outlook. Non-GAAP income from operations at $535 million would be an improvement from the $442 million the company generated in the same quarter the prior year. But the rate of improvement would not be as strong as the rate of improvement it demonstrated from the year before. You see, from 2023 to 2024, the company improved its non-GAAP income from operations by more than $200 million, or almost 100%, from $241 million to $442 million. They're now only going to increase their non-GAAP income from operations, or they're forecasting an increase of non-GAAP income from operations, improvement of roughly $100 million. So the absolute number is smaller and the percentage growth is significantly smaller than what the company demonstrated in 2024. So the big brouhaha about the company's 2025 guidance is the huge deceleration in both top and bottom line improvements. It's still improving, but the rate of improvement is decelerating. And that second derivative is something I've talked a lot about. When you're dealing with companies like Zscaler that are expected to grow significantly over the next decade or more, when they're trading at premium valuations, these second derivatives become increasingly important. When your stock price is this expensive, and Zscaler is not a cheap stock, it's trading at a forward price to earnings of 39, following the stock price decrease, it had approached valuations of forward PE over 60. And so that's a premium valuation. And when you're trading at premium valuations, it's because investors expect very strong growth in the future. And so when your growth rate decelerates, that brings down your valuation considerably because it's already baked into your stock price. Investors are expecting this growth. And so when they see numbers that threaten that growth, then the valuation comes down to more normal levels not indicative of a premium company, a premium valuation company. A premium valuation company has characteristics like a improving rate of growth, improving rate of profit growth. The second derivative becomes increasingly important when you're dealing with companies at premium valuations. And so the decrease in that second derivative for Zscaler is the primary reason the stock price is falling by as much as it is. Now, I've had Zscaler stock rated as a borderline buy, and I last updated that on May 30th. But do I think this dip in Zscaler stock, do I think this latest performance, the decrease in second derivative rates of improvement, is that a reason to downgrade the stock? I don't think so. I don't think it's a reason to upgrade the stock. The stock price decrease, I think, was justified if the company's growth is going to slow down by this much. I think a stock price decrease was justified. However, given that stock price decrease and given its new valuation, the forward price to earnings of 39.5, given its slower growth, I think it's reasonable. I think the risk versus return is reasonable to slightly favorable for long-term investors. That's why I have the stock rated as a borderline buy, not a straight out buy, because the price is slightly expensive. The company's prospects are excellent, but much of that is incorporated into the valuation. And so I'll update this today, September 4th, and reiterate that I think Zscaler stock is a borderline buy. So if investors are interested in buying this dip, I don't think it's a bad choice at current prices, 158. I would like it a lot more at 140, 145. I would like the stock a lot more, but at 158, it's not bad either. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.